What a week. It started with billionaire Bogan's Biffo and is ending with us all waiting to see what's in the budget next week. And we had one sort of diversion to one island of sanity in all this mayhem, which is the Reserve Bank building at the top of Martin Place in Sydney. We saw the Reserve Bank leave interest rates unchanged at the start of the week, as everybody predicted, everybody expected, although the commentators refused to accept the simple statement from the Reserve Bank that they're going to keep interest rates unchanged for a very, very considerable period. They are in no hurry to go either up or down. But the commentators continue to leap from statistic to statistic. You see a statistic which suggests the economy is going well. Oh my God, the Reserve Bank will be inclined to raise rates. You see another statistic which shows things slowing down. The Reserve Bank has to cut again. No, fellas, calm down, take a Bex. It's not going to happen. The Reserve Bank is going to see through all that short-term noise because its fundamental perception of where the economy is, it is pretty much not too hot, not too cold. Yes, the economy is not growing as fast as we'd all like it to grow, but it's growing at a reasonable pace. Yes, inflation is not as low as you might expect the Reserve Bank, therefore, to have no worries about it, but it's low enough. And if you look at the statistics, the forecast put out by the Reserve Bank on Friday, they showed it's anticipating that mix will broadly continue pretty much through the rest of the year and into 2015. The economy's growth will pick up a little bit towards that 3% and a bit higher, which is sort of the optimum and sustainable trend growth. And inflation, both headline inflation and underlying inflation, will stay most likely below 3%, but certainly not threateningly above 3% at any stage. Now, of course, the Reserve Bank knows it's not Nostradamus. It can't see the future. None of this is guaranteed. But this is its broad analysis, and it's the best analysis we've got in the economy. Budgets. From the Victorian state budget this week to the federal budget next week. What a difference 1 week makes. The Victorian budget was brimming over with revenue. The one next week is obviously going to be short of $1 because we're going to have another big deficit and pain. But this is really probably a tale of something slightly different. One budget coming 6 months after an election, one budget coming 6 months before an election. The Victorian state budget, election in November, this was a budget that had to have lots of goodies in it, and certainly no pain. So we saw the budget numbers come out with budget surpluses as far as the eye can see, tax cuts, the key tax that the state government has in its locker, which is payroll tax. Not a great cut in the payroll tax, and one that doesn't really help the very small businesses by much. They might save something like $100 or $200 a year, but certainly a significant cut to mid-sized businesses. And of course that huge infrastructure spend. So, you know, the Victorian State Treasurer had money to hand out galore. Joe Hockey next week is going to be a very different story. And it's the old story in one respect, which is after an election is when you have all the pain, you have all the slashing and burning. But no one should really be surprised that this is happening. They made that quite clear before the election. The budget numbers, the projections before the election were pretty bleak enough, and they got bleaker after the election. Now, whether you ascribe that to the government, the new government, fiddling with the books to make things look worse than they are, or the new government finally telling us the truth about the outlook, it doesn't really matter much at all, because the bottom line is the budget is going to be in serious deficit and something has to be done. And that something that has to be done is going to be mostly on the spending side by the government taking the axe right across the board, not just targeted cuts. They will be across the board cuts. And some tax increases, the two that stand out. One is temporary, which is the high income levy, which is mostly symbolic. The other is more serious, which is going to be an increase in the petrol excise and probably a return to indexation so that it goes up every 6 months and goes up and goes up and goes up. It's a very soft increase. It's a very soft way to raise taxes. I mean, it's not a soft increase. As for the market, in all this sort of uncertainty and mayhem, we saw a week in which the market basically went sideways. The market finished incredibly unchanged from 7 days ago, and this applied to both of the major sectors. Normally we see if the mining sector is being hit, the financial services sector is either going up or not hit as badly. But this week they both went broadly exactly sideways, which is an extraordinary thing. What does it mean? I think it tells us that investors are waiting for the world to break one way or the other, and they are particularly waiting to see what happens in overseas markets. The two big markets of importance to us obviously are the Wall Street, and in relation to the economy, what happens in China. So what this is telling us is we've got the strange mix of policy stability from the Reserve Bank, which should be providing a floor and some confidence to investors, countering, if you like, growing uncertainty about what is really going to happen in the global economy, what is really going to happen in global financial markets, and an expectation that at some point they're going to break either up or down. Yep. Okay.